What's going on, guys? Shake here, and today I'm bringing you a video in collaboration with Moet Finance about perpetual futures contracts. So if you're like me, you might have been trading them for some time and have had no idea what they really were. So this is just going to be a quick, simple breakdown in layman's terms of what perpetual futures are. And so if you're not familiar with Moet, they are a decentralized derivatives exchange on Solana. Definitely come check us out. But let's get right down in the video. I have a little slide deck to present you guys, as well as I'm going to go over an example with 100x leverage, which is like $10, just to kind of, yeah, I think it's helpful to see examples. So what are perps? They're also known as perpetual swaps, perpetual futures contracts, and they're proposed by this guy, Robert Shiller, who has a hilarious last name, to enable derivatives for illiquid assets. And so in 1992, they were a theoretical thing that he proposed, and they were introduced in 2016 by the popular exchange BitMEX. First, let's break down what are like regular futures contracts. So basically, a futures contract is an agreement to buy or sell an asset at a specified point in the future. So you could say, hey, I want to buy a futures contract to buy Bitcoin at 100K in 2 years. If you thought that Bitcoin was going to be more than 100K and you got that contract, then you can get a Bitcoin 2 years from now and you'd be getting it at a discount is basically the idea. So it's a derivative. So the price is derived from the underlying asset, but it's a completely different market than when you're actually buying and selling Bitcoin. The derivatives market it's a different order book. There's different pricing and everything like that. So that's what a normal futures contract is. A perpetual future doesn't have a delivery date, so they're a forever future. They're perpetual, infinity, whatever you want to call it, and so they don't have expiration dates, and they just go on forever. The components, the margin, the funding fees, and liquidation, and we'll get into all of that. So initial and maintenance margin. So let's say that you want to make a trade, you want to buy 100 SOL tokens, right? And let's say at the time they're $40 each and you want to buy 100 of them, you would be able to do that with a perpetual future with only 10. So that would be a 10x long basically on Solana. And this is kind of the example of what would, if you were to make the trade right here and you were wrong and it went down 10%, then your 10 SOL would be liquidated, because the way I think about it, right, is 10x times 10% is 100%. So basically when you're using leverage on a perpetual or really on anything, it's multiplying your trade. And so therefore multiplying your profit or loss. Now the funding mechanism, it can seem a little complicated, but it's actually kind of simple. So it's basically a way. So like I said, there are two separate markets, the futures, their perp market, and then the actual. So like if we went on Binance, right, you can buy and sell Bitcoin, and you're actually buying or selling real Bitcoin. And there's it has its price, and then has the order book, and people are buying and selling at different prices. Then there's the perpetual futures. It's separate. And so they need to have a way to keep the prices close. And that's with this funding mechanism. And so this example is from a Paradigm article, which I'll link below. Essentially, they're comparing it to like a thermostat. So when you'll probably hear other like YouTubers and people on Twitter talking about this, when they say funding is positive, it means that the price of the perp is higher than the actual price. So if we're talking about Bitcoin, the Bitcoin perp future is higher than the actual price of Bitcoin, and the reverse would mean the funding is negative. And so what happens is, if they want to, so right now, let's say the funding's positive. And so that means a lot of people are going long and the price of the perp is getting driven up. And I can actually show you this on Binance. So I loaded up like $100 on this. And so you can see right here, if we go to Bitcoin, the actual price of Bitcoin is 33,930, and on the price of the perp is 33,914. So the funding is negative, meaning that if you were to go long right now, you would get paid funding by the people going short. And so this is to incentivize it to come closer to the actual index price. It's pretty clever way of doing it, if I'll say so myself. So that's basically what the funding is. And yeah, let's go over a live example, and then I'll kind of explain why they work. So let's get really degenerate here. Let's look at the Bitcoin 3-minute chart. And on Binance, you can use 125x leverage. So as you can see, this will actually show it well. So I only have $100 in here, right? But if I'm using 100x leverage, it's only going to let me use 50 bucks, I believe. But so I can get up to, let's do 50x. So as you can see with 50x leverage, I'm getting 0.143 Bitcoin, but obviously I only have $100. That's not even close to that much. But with the leverage, you're making a trade of a much higher value than what your collateral is, what your margin is basically. So let's do an example. So let's just look. We're looking at this 3-minute chart, getting real degenerate. Let's say we're gonna go 100x long. I'm not gonna do it with all the money here, but we'll just do it $10. Do a market buy, boom. And so you'll see as the price changes, so if it moved 1%, again, think about the example I used. This is 125x your profit or loss. So if it moved 1%, then we would get liquidated before it moved 1%. So it's highly risky, but it's a way where you can get extra exposure to an asset when you only have collateral of a certain amount. So you'll see it's, right, I only made a trade with $10, so it's like I'm already down 5% on the trade, even though the price is barely moved because the leverage is so high. So if it went down close to 100%, it would liquidate me, sell the $10 of collateral, and this is happening continuously. So let's go back to the presentation. So I think it's interesting to think about, okay, maybe you understand what it is, but why do they exist? Why are they helpful? Why don't people just why don't they just borrow money and trade? So from the perspective of a trader, a futures contract is, again, you can get extra leveraged exposure to the asset. So because in this example, I'm using Tether, right? I have USDT in here. And I can put in $10 and Binance can say, okay, we're giving you, $1,000 of exposure to this. Even though they're not lending me the $1,000, I can lever up 125x. And they're saying, okay, because of our liquidation mechanism, we're going to say, yep, you bought $1,000 of this Bitcoin perp here. They don't actually have to lend me the money, but if I get liquidated or stopped out, my collateral, it's immediately sold and settled via the exchange. So they don't actually have to be lending and borrowing real money. So it's more capital efficient. And then as a trader, you can lever up. So you can, if you're trying to turn $100 to $1 million, you can use 100x leverage. I don't recommend it, but obviously you can, and a lot of people try to do that. And so, you can make trades. Basically, you can make trades of a much higher value than what your actual collateral is. And then the kind of more sophisticated trader would use it to hedge a position. So let's say you're heavily invested in Bitcoin, but in the short term, you see a lot of downside, but you don't want to sell your Bitcoin and then try to buy back later. You can just short Bitcoin via a perpetual future. Same thing, with an option or a real future, but it's just another way to kind of hedge a position. And, you can make, again, much higher value trades in those hedges. And from the exchange's point of view, it's more capital efficient. So since they don't actually have to lend the money out, they're not having to, charge people interest or, liquidate people and worry about them getting paid back. It's all kind of done within the perpetual exchange. And so this frees up capital for the exchange more, allows them to offer high volume trading on crypto assets. They can offer perps on pretty much anything. So if you look at the perps here, you have synthetics, compound, StormX. From as far as I know, they don't have options on StormX, let's say, right? But you can trade perps and you can trade with 50x leverage on StormX if you wanted to for some reason. And so, yeah, that's kind of why they exist. Check out these sources. Again, I'm going to put the slide deck linked in the bio below. These are all really good resources if you want to learn more, but I hope that this made sense. Again, just for the crypto bro trader who just wants it explained in layman's terms, I hope this made sense for you. Let me know in the comments if you have any questions. And again, feel free to come join us on Moet Finance. I'm always in their Discord doing live streams and things like that. And we have a good time. So if you have any questions about Perps or what we're doing, please let us know. Really appreciate checking out the video, and I'll see you on the next one. Much love.